Okay, so it's the top of the hour. My name is Paul Siegel. I'm going to moderate this webinar, which is being conducted by Doug Carroll. This is on capital markets and fixed income securities. We do a very brief 1 to 2 minute presentation and tell you a little about what we do, and then pass it off to Doug for him to take you through the content and the program. Just so you're aware, Starweaver is a finance project management and IT education company. It's been around for about 17 years. We do a lot of programs around the world. The tagline "education you can bank on" really comes from the fact that we deliver very predictable education in terms of the quality, the level, and the depth. We have hundreds of global clients, pretty much in every major financial center, business center around the world, from Australia and India and Belgium and Canada, United States, etc. We do 5 programs in 5 categories: cutting edge IT, enterprise IT, project management, business skills, and in this case, finance and banking. Almost everything is being conducted in a hands-on manner, that is to say, through these kinds of either live in-person or live online programs. The programs are mostly facilitated in person, but they're either live online or live in person. We do have a library of courses, large library, so feel free to access that. Everything we do is facilitated by top experts like Doug and others, whether it's in person or online. We do run retail programs, that is to say, to the consumer. Doug, for example, has facilitated a variety of pre-recorded programs. That's the Capital Market Immersion program you see here. It's available at starweaverinstitute.org and on Udemy and other sources. We have a Cyber Warrior program and Scrum programs. Check the Starweaver Institute if you'd like. These are the 2 finance programs that are coming up for the month of July. In the next week, we'll be adding a bunch more, so check back on our website to starweaver.com/events. Doug has a long-standing history in the finance sector. He'll tell you a little about that himself. I'd like to kind of promote and announce the fact that Doug does have a new book out. I'm pleased to mention, let me just see, I was going to show it to you here. It's on Amazon. I strongly recommend you to go out and buy it and take a look at it. Okay, so I will show you that later, but nevertheless, Doug has a long history in this business, as I mentioned, and we'll tell you a little about himself. We have, like your feedback, click on the link on the right chat box at the end of the program. You'll get free access to one of these courses, free access for life. There's the link. You'll see it in the right chat box. My name is Paul Siegel. Rand Shanik is one of our program managers. Piyush Arora does business development. And contact us if you have any questions. In the meantime, what I will do is pass this over to Doug, and again, look forward to your feedback and have a great program. Doug?
Thanks, Paul. Well, folks, let me welcome you to the 3rd session in our series. This one's going to have more of a micro focus. The first 2 sessions were much broader in scope, more macro in a sense, because they focused on markets, participants, and general characteristics and so forth. This session and the next session, we're going to dive into the weeds a little bit and start looking at some of the more important common characteristics and contract details from instruments traded in various market sectors. Before we dive into it, to honor Paul's promise, I'll say just a little bit about my background. Until I went independent near 20 years ago at this point, so for near a couple of decades, I've been mostly doing work as a trainer and independent consultant. Although in a couple of decades prior to that time, I split my time about 50-50 between the training and trading side of the business. So that while I do have an extensive background in delivering and developing content, whether internally at places like Citibank, I headed up the investment training areas of both Citibank's retail broker-dealer and their global private bank, and also worked for private training companies like the New York Institute of Finance. I did spend about half of my career on the trading side of the business in a variety of different capacities, whether working on bond trading desks at Citibank, managing money for a number of small asset management companies, or even briefly down on the floor of the Chicago Board of Trade. So I have a wealth of practical experience as well as quite a range of experience in presenting these ideas. So since this is a very ambitious agenda today, without further ado, I'm going to dive into our discussion of credit markets and fixed income securities. And as I indicated, this is a somewhat ambitious session, so most of the concepts we'll talk about are relatively straightforward, but the securities themselves can have a wide range of structures and features. And the idea here today is to introduce to you a lot of that terminology and the basic concepts and contract features. And as Paul indicated, what you might find a very helpful resource is a book published that I wrote, was published just in the last couple of months, called The Insider's Guide to Fixed Income Securities and Markets, which goes into everything we're talking about today and a much greater degree of detail, of course. So let's begin. So what's a bond? That's probably the most basic place to start. And a bond is really, in effect, nothing more than a loan. Now, it's of course, it's a loan that's been packaged in a way to facilitate transfer between one investor and another. And when I say packaged, I mean that all of the regulatory and or legal requirements have been honored so as to permit the issuance and then subsequent trading of the bond. But at its very bare essentials, a bond is really nothing more than a loan. Although sometimes the terminology used in the context of bonds versus loans is a little bit different, which might lead one to perceive them as different. But in either case, whether it's a bond or loan, there's someone that is providing funds to someone that is borrowing or obtaining those funds. And just to introduce the differences in terminology, of course, with a loan, you've got a lender, perhaps a bank, a commercial finance company, a savings bank, or whatever. In the case of the bond market, it's an investor that's providing the funds. And of course, the receiver might be referenced differently, known as a borrower in the case of a loan. But in effect, by issuing a bond, the issuing corporation, government, or government agency is simply using the bond as a vehicle for obtaining funds. Now, that's not there to say there are not differences between the creation, which is sometimes referred to as origination of the different sorts of instruments. But we'll not touch on those issues this time, as that was addressed in both the first and second of these webinars. So if you want more detail on the creation of bonds or loans and the similarities and differences, you might want to look at the recording of either of the first of the two sessions. Some basic terminology before we get too much farther into the discussion. When you're watching some presenter, a bond manager or economist talking about the credit markets on CNBC or Bloomberg Financial, they'll bat around a bunch of phrases if they're completely interchangeable. So you'll hear such speakers talk about bond markets and debt securities markets, credit markets, and fixed income markets, oftentimes as if they're one and the same thing. Now, it's important in any business, of course, but since we're speaking about the finance business, it's important to develop here a facility to listen to a speaker or read an author and understand whether they're using a word or phrase in a technically precise fashion, or if they're just using it as a way of making some general reference. And oftentimes when the speakers I'm citing on one of the financial networks are using any one of these four phrases, they're making the same reference. It's just that rather than saying fixed income markets, fixed income markets, fixed income markets, every time they want to reference this issue, they want to change it up a little bit to make the words a little bit more engaging. But since we're talking about first principles here, let's be technically precise in sorting out the difference between the bunch of these things. So now it does turn out that of those four, two of them are more effectively the same. Though some might quibble, generally bonds and debt securities mean the same thing most of the time to most people. So for our purposes here, we'll say bond markets and debt securities markets are effectively the same thing. But what about the other choices we have to consider here? Because let's say we want to be a little bit more specific about this, and we want to try to identify the differences or the different implications associated with those different phrases. So in effect, we're going to say we've got three categories to work with. one being bond markets or debt securities markets, a second being credit markets, and the third category being fixed income markets. Again, oftentimes when you're listening to a speaker or reading an author, they're using these phrases interchangeably. But since we're introducing the concepts, let's be a bit more technically precise with these issues and try to identify and distinguish between the bunch of them. Because as it turns out, one of the three categories that I just highlighted is much larger than the other two. In fact, it is so large it completely encompasses one of the others and subsumes about 97 or 98% of the third. So which of these categories of the three, bond or debt securities markets being one, credit markets being two, fixed income markets being three, which is the largest or most encompassing of the bunch? Well, by far, it's credit markets. Now, credit markets are the markets in which any sort of credit instrument might be issued or created or traded. So what's a credit instrument? Well, a credit instrument is any legal contract or financial instrument that obligates one party to make payments to another party. The party obligated to make payments generally being referenced as the obligor, and the party that is to receive the payments would be the owner of the contract. In many cases, that would be the originating lender, but in many cases, the credit instrument might be passed on to someone else. So let's be a little bit more specific than just talking about credit instruments so generically. So what's some examples of common credit instruments that the most might recognize? Well, for instance, a mortgage is an example of a credit instrument. A mortgage would be created when some home buyer or possibly someone refinancing an existing loan borrows money, in our example here, borrowing money to purchase the home. So the money so borrowed is handed off to the seller of the home, and the buyer now owns the property, although the lender of the funds holds the mortgage as evidence of the indebtedness. So that mortgage is one example. The mortgage loan is an example of a credit instrument. Or another example would be a credit card receivable. If a diner at some restaurant pays for their meal by offering up the credit card, well, of course, the credit card itself doesn't represent money. By using the credit card, in effect, the restaurant is obtaining the funds for purchase of the meal from the credit card issuer. And then as a result of using the credit card, the diner in that case would owe the monies that were used to buy the meal to the credit card company itself. Use of the credit card creating a credit card account receivable, another example of a credit instrument. Or someone buying a car. They might borrow funds from an auto finance company and then use the funds so borrowed to obtain the vehicle, ownership of the vehicle. And well, in the vernacular, it would be called an auto loan. To be more specific, it's what's known as a retail installment sales contract, but another example of a credit instrument. So any bilateral contract that's created as a result of someone obtaining funds to acquire something else, if those funds are then repayable over time, that creates a credit instrument. So all credit instruments are part of the credit markets. And bonds, whether issued by governments, government agencies, corporations, or whoever, those are also credit instruments and therefore part of the credit markets. But the bond or debt securities markets, in effect, represent a subset, a significant subset, but nonetheless a subset of the credit markets more generally. So again, oftentimes when someone says credit markets, especially if they're on one of the financial networks, they're using it as a way of saying bond or debt securities markets. But if one wanted to be technically precise, one would need to realize that the credit markets are significantly larger. And many credit instruments are bilateral contracts between the originating lender and the borrower, and they remain bilateral contracts for their entire existence. So they therefore, auto loans or mortgages or credit card receivables might never be part of the bond markets, although they're always part of the credit markets. On the other hand, the three sorts of credit instruments identified previously are actually quite commonly securitized. So for instance, some mortgage lender or some third party, like one of the mortgage agencies in the United States, Fannie Mae or Freddie Mac, for instance, they could put together a pool of mortgage loans and then sell those to investors as mortgage-backed securities. Well, all of a sudden, those credit instruments have moved from being in the credit markets generally to now being properly thought of as trading in the bond or debt securities markets. Or similarly, auto lenders, or again, it's possibly a third party acquiring the retail installment sales contracts from other lenders, but they'll create a pool of auto loans and sell those off as auto loan asset-backed securities. Or credit card issuers oftentimes will find it cheaper to borrow rather than selling bonds that are general claims against the credit card issuing company. They'll find it a cheaper source of funds to transfer a bunch of credit card receivables to a trust account and then sell claims against that separate trust account, in effect creating credit card receivable asset-backed securities. So all credit instruments, including debt securities, are part of the credit markets, but not all credit instruments are properly thought of as belonging to the bond or debt securities markets. What about fixed income markets? Aren't those basically the same thing? Well, again, to be technically precise, no. All bonds or debt securities are thought of as fixed income instruments or fixed income securities, but not all fixed income securities are going to be considered bonds or debt securities, because a little piece of the fixed income market is comprised of a type of equity known as preferred stocks. Time prevents us from going into them in great detail, but most preferred stocks are considered equity securities, at least from a legal or an accounting perspective. But because their features are so bond-like as investments, they're considered fixed income securities, and therefore would be lumped together with bonds when one was doing an asset allocation analysis of one's portfolio. Now, let's dig into the details of the debt or fixed income contracts, at least in a little bit of granularity. And there's many different ways of dividing up the bond market, but for our purposes here today, let's make a distinction between single obligor debt securities, in other words, bonds or debt securities that are the obligation of one specific borrower, and that might be a government or government agency, might be a regional or local government. So in the US, states issue bonds, the provinces do in Canada, so do the Staaten in Germany. And depending on the legal arrangements, in some cases, even local county or city governments can issue debt securities. And then, of course, there's the corporate bond market as well. There's exceptions, but in the vast majority of instances, obligations issued by an entity falling into one of those categories represent the debt obligation of a single borrower. And most of our discussion will be about the features of such contracts. But while the features of the single issue or debt obligations transfer to another segment of the market as well, what we could refer to as structured securities usually represent a significantly different form of debt instrument. Not always, but in the vast majority of cases, mortgage-backed and asset-backed securities and collateralized debt obligations, although CDOs got such a bad connotation in the context of the last financial crisis that the only segment of that market that has made much of a comeback is now the CLOs, or collateralized loan obligations. Most of the time, these securities represent a packaging of claims against many different individual obligors. So there's a pool of mortgage loans, or a pool of auto loans, or credit card receivables, or a pool of bank loans that is the source of cash to be paid out to investors. And we'll look at the general structures of those towards the end of the session. But before we do that, let's talk about the general features that are common to the vast majority of different fixed income or debt securities. So most of the succeeding discussion will focus on the major contract features and the related terminology that are held in common with the vast majority of securities. So we'll look at par value, issuer, coupon rate, maturity, and price, and at least introduce some of the related terminology and concepts associated with these aspects of the fixed income securities or debt contracts we'll talk about. And what we'll use to illustrate these contract features are the information represented in the hypothetical bond quote at the bottom of the page, which I'll run through in industry jargon, which will be almost unintelligible at our first pass. But then on the next page, we'll see it again, and I'll walk through the contract a little bit more sedately and explain the meaning of the words. And then over the subsequent dozen or so pages, we'll look at each of the contract elements in a little bit more detail. So the way someone in the bond market might render the information at the bottom of the page is to say, oh, I have 100 XYZ 4 3/4 of 24 trading at 95. Now again, unless you're familiar with the bond market, that might not have made much sense, but let's look at each of those contract elements in a little bit of detail. So there you see a reprise on the next slide of the hypothetical bond quote from the bottom of the previous slide. Let's look at each of the elements of that contract information in just a little bit of detail at the next pass. And then as promised, over the subsequent pages, there'll be a slide or two that relate to each of those contract features, and we'll go into them in just a little bit of depth. So first off, we have an indication as to the par value. And the 100M, and I'm using US conventions here, that would stand for 100,000. This brings up an interesting point. Anytime you are familiar with specific conventions or meanings of symbols in a particular market or market segment, don't automatically assume that the same interpretation would be applied in all market segments. Because while in the US, 100M would stand for 100,000, in the UK, that would stand for 100 million. But that represents the par value, the amount the issuer will have to pay to extinguish the liability, and the amount that the interest is payable on. But more about that in a few pages, or in the next page, as a matter of fact, when we look at par value in detail. Next up, XYZ is an indication as to the issuer of the debt. In my hypothetical example, the infamous XYZ Corporation. Followed by an indication as to the coupon rate. That 4 3/4 apostrophe S is simply a common way of indicating in the fixed income markets a coupon rate of 4 3/4%. So that's the percent of the par value that will be the interest due in each year over the life of the bond. Next up, 24 indicates the year of maturity. Of course, every bond has a specific maturity date, although maturity dates might be deferred or accelerated depending upon the terms of the contract. But most of the time in a bond's general contract or information or quote, you would simply see the year of maturity, and you'd have to dig into the Bloomberg pages or look at the offering documents to discern the specific day within that year in which the bond matures. But what the contract indicates so far is that the XYZ Corporation will have to pay interest equal to 4 3/4% of the par value year in and year out through the maturity date in 2024, although we'll look at the mechanics of those interest payments on one of the subsequent slides. And the final number on this page is an indication as to the price. Bond prices are generally expressed as a percent of par value. And so that 95 would mean 95% of par. And again, that's something that is shown in more detail in a subsequent slide. So let's hold the detail until we get to the slides looking at price. So the first number on the previous slide was par value. It's important to realize that a number of words or phrases are used interchangeably to reference that same quantum. So par, par value, face amount, face value, principal, principal amount. For the vast majority of securities, those are just different ways of referencing the same thing. So for term bonds, that is bonds where all the principal is due at maturity, generally all 6 of those words or phrases would mean exactly the same thing. The dollar amount, well, that's of course, if you're in the US, it would be the yen amount in Japan, or the sterling amount in the UK, upon which the percent interest is payable and the amount that will have to be paid to the bondholder to extinguish the debt, to terminate that liability, that obligation. Now, since I specified this is true for term bonds, that likely indicates there are other sorts of securities. And in fact, there are many amortizing securities. In other words, securities where the principal is payable over time, rather than all due on a single date. Well, for amortizing securities, there's going to be a distinction between the original face amount and the current outstanding principal. And in general, interest would only be payable on the current outstanding principal, not on the original face value for the entire life of the security. So at issuance, the outstanding principal and the original face value are one and the same. But then once amortization begins, there's a difference between the two. And as by way of example, in the mortgage-backed securities market, they will quote securities by an original face value, but then also identify a factor that says what percent of the original face is still outstanding, and that's how one would determine the current outstanding principal. And that would be the amount that interest was payable on in the current period, as well as the amount of principal that would be due the holder of the security over the remaining life of that security. Now, a little bit more on par or face value. Why face value? Well, face value, face amount, they are a sort of a residue of history, because nowadays most bonds exist in book entry form only. There's a record on some paper, or increasingly on some electronic ledger, that reflects the amount of principal owed. But once upon a time, when I first got in the business back in the 1970s, the vast majority of fixed income securities had a physical embodiment. There was literally a piece of paper, a bond certificate, and that embodied the ownership of that security. And so here you see a somewhat dated example from a couple of centuries ago, as a matter of fact. And it's even though issued by the city of Boston, this was many years ago, so London was the primary financial market at the time. So the city of Boston was borrowing in pounds sterling. But you'll note that the principal or par amount is printed on the face of that certificate, ergo the terms face value, or face amount. And at the bottom of that illustration, you see the coupons. Back in the day, for a bond to be good delivery, all of the unpaid coupons had to be attached. And since they were perforated to make for easy tearing off to turn in for your periodic interest payment, oftentimes the coupons would become separated from the bond certificate, greatly complicating the problems in the back office and making sure securities in the right form, so in fact they were eligible, or as they say in the business, good for delivery. And I don't know if anybody online is a fan of old movies, but you'll sometimes hear references in movies made in the 1930s or 1920s even to coupon clipping. Well, growing up in the 60s as I did, to my mind, coupons were things that were saved by people to try to buy things at a discount, or turn in a book of coupon savings that they had pasted in a book to get goods free. Nowadays, of course, even coupons are virtual, as in Groupon. But if you run into any references to coupon clipping, because it was typically made by people riding around in fancy cars, the reference in these movies back from the 30s to wealthy people clipping the coupons to send in to collect their periodic interest payments. A little bit more on par value. Remember, the 100M stands for 100,000. That's the par value. And note, in the jargon of the business, that might simply be referred to as 100 bonds. So sometimes the word bond is synonymous with $1,000 par value. 5 bonds would be a shorthand way of saying $5,000 par value. 50 bonds would be a shorthand way of saying $50,000 par value. So again, this is true in many cases when you're using jargon. The word bond might be a reference to a specific security, or it might be a reference to the par amount of some security. One has to develop the facility for listening to the speaker, or again, reading the words of the author, and trying to get a sense of in which way they're using a word that has so many different potential meanings. One of the things that get quite complicated for people that are new to the bond market is understanding that the principal amount, while it is the issuer's obligation to pay interest on the outstanding principal and pay the full principal amount to terminate the obligation, terminate or extinguish the liability, the principal amount is not necessarily the amount borrowed when a bond is issued. And this is one of the differences between bonds and loans. For loans, the amount borrowed is typically the principal amount. But because of an obscure coupon setting convention, oftentimes bonds are issued at a slight price difference from par value itself. Usually they're issued at a slight discount to par, or at least quite often that's the case. So principal amount does not equal necessarily the amount borrowed. The amount borrowed is the issue price. But regardless of whether a bond was issued at a premium or a discount, it's the issuer's obligation to pay the full principal in addition to paying the contract interest to meet the terms of the contract. And that would be true even if the amount originally borrowed was not equal to the principal amount. And just in passing, it should be noted that one of the other important aspects of par, besides in conjunction with the coupon determining the size of the annual interest payments, the size of the bond you're trading will impact the price and potentially the ease of buying or selling, the liquidity. So as is true in all markets, it's easier to trade something and you'll get a better price when you're trading in the normal trading unit. That's what a round lot refers to. So if you're trading an odd lot, you're likely to have to pay a higher price to buy or accept a lower price to sell. Unfortunately, unlike the equity market where 100 shares is typically a round lot, there's not a universal definition of round lot in the bond market. So it might be $10 million in the US Treasury market, $10 million par value, whereas a round lot in the corporate or muni market might be 100 bonds. Next up, let's talk about the coupon rate. So the 4 3/4 is just a general reference to the coupon rate, 4 3/4%. Why the apostrophe S? I honestly don't know the genealogy of that convention, but it is a common way of expressing coupon rates. Although one possible reason for that would be the way that bonds are oftentimes identified in the fixed income market. These bonds that we're using as our example could be referred to as the XYZ 4 3/4 of 24. Oftentimes, simply by identifying those three contract features, issuer, coupon rate, and year of maturity, that's enough information to distinguish that one security from the literally millions of other bond issues that are currently outstanding and trading in the markets. And I'm not exaggerating to say millions of different bond issues. Now, of course, it's possible that for the same issuer, there are multiple issues that have the same coupon rate and mature in the same year. So I'm not saying confusion could never arise in that context, especially for prolific issuers like the US Treasury. But in the vast majority of instances, by identifying those three features, issuer, coupon rate, and year of maturity, you've provided enough information to distinguish that one bond issue from all of the other millions of issues outstanding. As indicated earlier, one would be able to compute the annual amount of interest owed by the issuer or due the bondholder by multiplying the coupon rate times the par or face amount, which is shown in the most recently indicated line. So 0.0475 is, of course, 4 3/4 in decimal terms, and that would indicate that the issuer owes the bondholder $4,750 a year. Now, that's the annual amount. What about the amount due on each payment? Well, that would depend on the coupon payment frequency, the compounding frequency, as it's called. And while $4,750 would be the annual amount due in this case, in most countries, that would not be the amount due on each coupon payment date, because in most countries, at least in most market segments in most countries, coupons are payable more than once a year. However, on most of the countries, or in most of the countries on the continent of Europe, not in the UK, but on the continent of Europe, and because in the Euro bond markets, they follow the conventions of the European continental markets, they do pay annual coupons. So a bond issued by the French government that had these terms, or even a dollar-denominated bond issued by a US corporation in the Euro bond markets would probably only make a single annual payment of $4,750 on this $100,000 par value security. On the other hand, in many countries, semi-annual is the norm. For instance, that's true in all of the English-speaking countries, US, UK, Canada, etc. So that would mean that $23.75 would be the semi-annual coupon payments due. And quite a number of countries actually quarterly is the most common frequency. That's true in Indonesia and Korea, I believe. And note, by the way, the quarterly coupon is being determined by dividing the annual amount by 4. Note, while that would generally be true, it would depend on the day count convention used in that country and that market sector. And there are many different day count conventions, and that's a level of detail that, again, is beyond the scope of this discussion. But looking at an appropriate resource, you could find some information on the different ways the fixed income markets account for the passage of time. Now, how are those coupon payments structured? In the example, I was assuming a fixed coupon rate that was constant over the life of the bond. And while that is probably true for the majority of long-term coupon paying securities, there are certainly numerous exceptions to that general rule. So that, for instance, there are many floating rate instruments where the interest rate varies based on some index rate and differential. And there are even what are known as split rate or split coupon securities that pay a fixed rate of interest. It's just that they pay different fixed rates of interest over different portions of the life of the contract. Maturity, well, for term bonds at least, that's the time when all the principal is due. Term bonds that don't have any provisions for early retirement are oftentimes referred to as bullets because you get all your principal in a single shot. On the other hand, as indicated earlier, there are many types of amortizing securities where the principal is paid over time. And there is normally an amortization schedule, the schedule according which the principal is supposed to be paid out, although on many amortizing securities that is not a fixed amortization schedule because the borrower or the creditors whose obligations have been securitized, like in the example of mortgage-backed securities, they have the right to prepay. And of course, that complicates the understanding of fixed income securities when you don't know exactly how long each dollar of principal will be outstanding. The provisions for early retirement would include calls. That's where the issuer or borrower has the right to repay early. Puts, that's where the bondholder, him or herself, has the right to force the issuer to repurchase the security, although put provisions are much less common than call provisions. And there are even sinking fund bonds. Now, unlike calls, which are usually at the option of the issuer, sinking fund bonds are bonds where the issuer is obligated to retire some portion of the principal amount prior to the stated maturity. But since calls are the most common, let's look at those in just a little bit more detail. Calls might be optional, as the early retirement might be at the issuer's option, or under some cases, they might be mandatory call provisions triggered by some event. And if it's an optional call, the issuer usually has to pay for the privilege of retiring the bond early, so they would likely have to pay a premium to par. That's not always the case on mortgage-backed securities. Generally, mortgages don't have a prepayment penalty, so mortgagors can repay their loans at 100 cents on the dollar. But most corporate or government issues that are callable would normally require the issuer to pay the bondholders a premium if they retire the bond early. As far as the way bond prices or values are represented, especially for longer term securities, they're typically quoted by a price, although there's different ways of representing that price. It might be a dollar price or sterling price or yen price. So in other words, a dollar price per dollar of par value. But oftentimes securities are quoted on a percent of par basis. And just to complicate things a little bit, sometimes that percent of par quote might be in a decimal form, percent and hundredths of a percent. On the other hand, sometimes it's done in fractions, and we'll see examples of both in just a moment, so I'll save the detail there. But an entirely different way of quoting fixed income security values is to quote them on a rate basis, quote in other words by an interest rate or a yield. But understand whether a bond is quoted on a price basis or a rate basis, even bonds when quoted by a rate or a yield, that rate or yield quote implies one and only $1 price. And so when a trade settles, whether quoted on a price basis or a rate basis, the buyer is expected to pay the dollar price implied by the price or rate quote. But in addition to the price that was agreed at the time of the trade, the buyer will also owe the seller the accrued interest, because the way the fixed income markets generally work is that the holder of the security on the coupon date gets the entirety of the coupon payment. So for bonds that trade between coupon payment dates, the seller has to compensate the buyer by paying not only the price the two have negotiated, but also the portion of the next due coupon that was earned from the last coupon payment date up until the settlement date of the trade. Let's look at that in a little bit more detail. So the 95, of course, that's 95% of par. And so by taking the decimal equivalent of 95%, 0.95, and multiplying that by the par value, we get the price. Now that price, and when the word price is used by itself, it might be short for market price, market value, or flat price or clean price. That's how bond values are generally quoted, or the basis on which bonds are traded, the market price, flat price, or clean price. But per what we were saying in the previous slide, while bonds are quoted by a flat or clean price or market price, the presumption will normally be that when the trade settles, the buyer will have to compensate the seller for the accrued interest. That again is the interest that was earned starting on the last coupon payment date and running up to but not including the settlement date of the trade. So while bonds are quoted flat, they trade with interest, and the full value of the bond, the market price plus the accrued interest, is what's known as the dirty price. Just a little bit more detail on price, because to make the first pass easy, I assumed the bond was quoted at 95% of par. Oftentimes, in fact, most of the time, bonds will not trade right at a round value. In other words, there will be a percent of par and a fraction of another percent. So let's say we see a bond quoted at 95.20. Now, if that's a percent of par represented on a decimal basis, as is true in the corporate or municipal bond market in the United States, that 95.20 would be 95 and 21/100%. So the decimal equivalent would be 0.9520. Multiplying the decimal equivalent of the market price times the par value gets us to a market price of $95,200. On the other hand, if that was a quote on an agency mortgage-backed security in the United States or a treasury security in the United States, that 95.20 would actually mean 95 and 20/32% Now, depending on the information source, the full percents and the fractions and another percent might be separated by a colon or a dash. That probably puts the observer on notice that this is not a decimal quote. Unfortunately, many information providers simply use a dot to divide the full percents from the fractions of another percent, and especially for someone that is not aware of the convention, looking at price quotes on U.S. corporates versus U.S. treasuries creates a potential conflict because of the difference in the conventions. But that 95 and 20/32, well, 95% is where the 0.95 comes from. 20 divided by 32 is 0.625, but of course that's 0.625 of 1%. So the decimal equivalent of 95 and 20/32 is the 0.95625 shown there. So that would lead to a market price of $95,625. So even though you could see either a corporate or a treasury bond quoted at 95.20 as indicated at the top of that slide, the implications of the 95.20 could vary depending upon which market sector you're looking at the quote from. Just a little bit about terminology. One of the complicating, in fact, probably the most complicating word in the fixed income market is the word yield. And the reason is because there are numerous meanings associated with the word yield, and that is unfortunately a recipe for confusion. So what are the four most widely associated meanings that are implied by use of the word yield? Well, and note, because the word yield is oftentimes used by itself, one will frequently have to infer the meaning by the context in which it's used. If authors or speakers are being careful, adding a word or two to qualify the specific meaning could make the implication of their words a lot clearer. But let's look at the four most commonly associated meanings that are implied by using a word yield by itself. So the common meanings are rate of return, interest rate, cash flow, or what sounds complicated, current value. In other words, it's a way of expressing the market value of the security, as was indicated when we talked about ways of quoting bonds a few slides back. Let's briefly look at the little bit of detail in terms of the implications of those meanings. So just to put it in context, you might be listening to a bond portfolio manager or bond market strategist talking to one of the hosts on CNBC or Bloomberg Financial, and a common point of discussion is, so what was your performance in the last quarter? Well, the portfolio manager might say, my portfolio earned a yield of 4.55% last quarter. Used in that fashion, yield clearly implies a rate of return. However, oftentimes when someone uses the word yield, it's a reference to one of the many interest rates that have the word yield in the name of the interest rate. Just a few examples: yield to maturity, yield to call, yield to worst, nominal yield, current yield. I'll stop there at 5, but I could easily think of another half dozen or more interest rates that have the word yield in the name of the interest rate, and oftentimes the speaker or author is simply referencing one of those interest rates. Probably more common than the others, yield to maturity or yield to call, depending upon which of the two is appropriate, but it could be a way of referencing any of the interest rates that have the word yield in the name of the interest rate. Cash flow. Well, oftentimes in recent years, you've heard a bond portfolio manager being interviewed on CNBC being asked about what they've been buying recently, respond with something like, well, rates of return, interest rates have been so low, I've found myself venturing into types of investments not normally part of my portfolio. And recently I've been buying some REITs, real estate investment trusts, or similar comments are made about common electric utility common stocks. And those securities generate a really attractive yield. And oh, by the way, I might get some appreciation while I'm collecting that attractive yield. Clearly, by separating those two components of return, the yield was a direct reference to the cash flow, the dividend yield being collected while they were holding the security. Now, some might be saying, well, those are equity securities. Why am I bringing them up in the context of a fixed income discussion? Well, one, I'm citing actual statements I've heard frequently over recent years, and it was just an easier way to make the point, because I've also heard bond portfolio managers make the same comment about high yield bonds, so-called junk bonds, buying them for the attractive yield, i.e. the really fat or high coupon rate, and that's the attraction, because who knows if the junk bond issuer will be around in 10 or 20 years to return the principal when it's due. And again, bonds can be quoted on a yield basis. So oftentimes if one cites a bond's yield, it's not going to be a reference to its future returns, more about that in just a moment, but simply a way of expressing the current market value of the bond. So when you hear the word yield or read the word yield, the first thing you ought to ask yourself is which of these many meanings are being implied by the speaker or the author. And all too often, unfortunately, the speakers or authors haven't sorted through these different strands of meaning in their own mind. So unfortunately, that means they are not being very clear in expressing themselves if they haven't separated these different ideas and they're using the word yield a bit too indiscriminately. Now, what about yield to maturity? If yield is the most confusing word in the fixed income business, yield to maturity is possibly the most confusing concept in the fixed income market. Because all too often, people don't recognize yield to maturity as industry jargon. Jargon? Well, a specialized language people in a given business have developed as a shorthand way of expressing very complicated ideas or complex processes by a single word or a short phrase. And unfortunately, that means jargon cannot be interpreted by looking up the meanings in a Merriam-Webster's dictionary of the individual words, and then inferring the meaning of the phrase as simply an aggregation of the definitions of the individual words. That's not the nature of jargon, although all too often the uninitiated will come to the wrong meaning in exactly that fashion. Because oftentimes the word yield, as indicated previously, means rate of return, and so people then unfortunately leap to the conclusion that yield to maturity must mean rate of return to maturity. Unfortunately, almost nothing could be further from the truth. Think about say a 10-year T-note. On the 10-year T-note, there are 20 coupons. If I hold that 10-year T-note to maturity, The last of the coupons, since it's receivable at maturity, will contribute only the dollar amount of that coupon to my rate of return. What about the first 19 coupons? If I didn't know the rate of return earned on the reinvestment of the first 19 coupons in the 10-year T-note, how could I possibly know my rate of return to maturity? The true meaning of yield to maturity is the interest rate that expresses the current market value of the security. And unfortunately, that is misdescribed in the vast majority of introductory level fixed income books, which typically describe yield to maturity as the rate of return to an investor who buys a bond and holds it to maturity. Unfortunately, per the previous discussion, that is not likely the case. Now, just briefly on the complex structures, the mortgage backs, asset backs, and collateralized loan obligations that were introduced briefly earlier. All of those instruments are created by what's known as an asset securitization. What's an asset securitization? Well, the underlying source of cash are typically the credit instruments created by some transaction between a borrower and a lender. And again, that borrower might be a credit card user and the lender the credit card issuer. And it used to be that credit instruments were held by the originating lender as interest earning assets. But starting with the mortgage-backed securities market in 1970, and then gradually increasing, although becoming a significant flow by the early to mid 1980s, at which point you also saw the development of more asset-backed securities and shortly thereafter collateralized debt obligations. You saw the originators of the credit instruments transferring those instruments to a special purpose vehicle, typically set up as a trust account. And once a pool of such assets had been created, and note, of course, these credit instruments are liabilities from the standpoint of the borrowers, but they're assets from the standpoint of the originating lender. The originating lender might be creating the trust account on their own, and it might be a single originator pool, although the example here is a multi-originator pool. And once that pool of assets was put together, units of interest would be sold to investors. And then subsequent to that point, the cash flows to the investors would be coming from the borrowers as they made payments on their obligations. And the structures of the payments would vary dramatically depending upon whether it was a pool of auto loans or credit card receivables or asset-backed securities. No time to get into the detail because each of those are subjects that could easily be talked about for hours on end. But just to give you a brief idea of the different ways the payouts are structured. It might be structured as a pass-through security. That's where every investor in the pool, holders of mortgage-backed securities, for instance, agency pass-through securities still have this structure. All investors in the pool are getting their pro rata share of every dollar of interest and principal that's being distributed each period. So that is still a common structure for agency mortgage-backed securities, and the original asset-backed securities were structured in this fashion as well. But since the late 1980s, a significant portion of mortgage backs, some agencies, all non-agencies, and the vast majority of asset-backed securities and collateralized debt obligations structure the payouts as well. So in effect, there's two forms of structuring: the asset securitization, the creation of the collateral pool, and then a structuring of the payouts as well. So it's likely that holders of all the different classes of debt, and that's what the word tranche is a reference to, a different class of debt issued against the same asset securitization. So investors in all the various debt tranches are probably receiving interest each period, although depending upon the terms of the contract, they're likely receiving different rates of interest. But what will definitely vary is the return of principal. So in a simple structure, initially, all monies to be paid out as return of principal would be paid out only to the shortest term tranche outstanding. And once it was paid off, then and only then would investors in the tranche that's due to get its principal back next would start receiving their return of principal. And only once the investors in the second principal return tranche had received back every last principal, then and only then would the investors in the final tranche start receiving their return of principal. Now, this is obviously a very simplified example. Those would be what would be referred to as sequential pay tranches. And the facts that determine the priority of return of principal vary dramatically depending upon the type of securitization. But those are all levels of detail that are way beyond what we have time to address. So since we're very close to the end of the session, I'll stop the presentation there, but I'm happy to stay online and respond to questions about anything discussed or stuff related to things that were discussed. So if any of the participants have questions, please let me hear them and I'd be happy to respond.
Hey, Doug, this is Paul. Thank you for a great presentation, lots of detail. Paul, obviously Doug has covered a lot in a very short period of time, and if you were all experts at this time, I would be shocked, but that's not the point. The point is to become familiar with this material, and then we'll do more deep dives. There's obviously a lot of complexity underneath some of these securities and what Doug has been discussing, so don't feel shocked if you're not fully, comfortable yet with what this is all about. I do highly recommend, and I think on the right side you will see a link to the book that Doug just had published, and it is on Amazon. I highly recommend it. Let me see if I see it. If not there, I will.
It's available both in hardcover and on Kindle for those that prefer to consume it electronically.
Yeah, and I thank you, Doug. And it's just been pushed out on the right there. So if you want that link, it's right there. I highly recommend it. And frankly, if you have any flavor of what, if you're looking for a flavor of what you've just received, which is a lot of information, it's a very substantial tome. It's a real big and substantial book. So I highly recommend it to you. At this moment, it does not appear as anyone has any questions. Again, you can always send a question at some point later to helpdesk@starweaver.com. We also very much appreciate your feedback. There's a feedback link. With that feedback link, you get access to one of the courses, including some that Doug has delivered for us. So I highly recommend you follow that link there on the right as well. And if you have any questions, again, always send a question to helpdesk@starweaver.com. Doug, once again, fantastic presentation. We appreciate you doing this, and everyone else have a great day and a great weekend. Thank you, Doug.
Thanks, Paul. Be well.
I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.